The Bank of England is pushing back on that Financial Times report about its quantitative easing plans. What's your reaction, and what do you see that? How do you see that impacting not only the UK financial market but also the global?
Yeah, so that they're denying that they want to delay the quantitative tightening may not become as a surprise in the sense that tomorrow we'll get CPI data out of the UK, and that will involve, I think, the turmoil that we've just seen. So, you know, inflation in the UK is out of control, right? It's rising faster and faster. So the Bank of England is very reluctant. So it will impact our markets because there's correlation between UK gilt yields and our treasury yields. And as we know, as treasury yields then start to rise again, it affects our equity market. So I think that relationship hasn't ended yet. But I do think that the Bank of England is very wary of the instability of the gilt market. So it will come back with more measures to try to at least stabilize the market.
So is the goal here by the Bank of England pushing back on this FT report, and thank you for correcting me, quantitative tightening, not easing in this case, is the idea here to get inflation under control? What's the overall goal? Because obviously inflation spiked after the tax cuts and some other issues over there in the UK.
Yeah, that is the primary goal. You know, obviously they have been not hiking as fast as the Federal Reserve, while inflation has run away from them much faster even than what we have experienced. So they're in a kind of a tight spot, and they felt like we cannot really let the government drive this process. We got to control inflation. That's their mandate. So I think that's why it's not surprising that denying this report. They are moving forward with selling corporate bonds. That has been going on. So they have these 3 facilities in place that allow for liquidity to the markets, and I think that's what they want to use to try to keep staying stable while they're getting on track to hike rates in November and go on with quantitative tightening. It will continue to be a pressure point, Frank. It's not going to be that simple to just simply signal to markets that with liquidity, things are going to be stable.
All right, let's turn our attention back to the U.S. markets while we have you here. Yeah. You say we're in a technical bear market, but the moves you're seeing on the VIX are actually setting us up for a potential rally. You believe we could have a near-term rally up to 3,800. That's only a few points from where we are now, but more than 300 points off the new low that we hit earlier this month. What about the VIX is setting us up for this potential rally?
So what we call the VIX curve is the futures, right? It's inverted, so the VIX rate is now higher than where the futures are. And that tends to be a good catalyst. And people look at this like, okay, volatility is high. If you're getting a bit of a traction on the market, then that relationship, that VIX curve would normalize, and that would, you know, stimulate the market, as in there's more rally coming. We all know there's a tremendous amount of people on the sidelines, lots of cash balances, very negative sentiment. There's a short position in the S&P futures. So it does set us up for a technical bounce. That 3,800 is, I think, a very important technical level. If it breaks, which we're not far away from it, yeah, it sets us up for a bit further for rally. And I would coincide with people like Mike Wilson, who've said, like, you could hit 4,000. It's still a bear market bounce, at least in the downtrend of the bear market. Right. But it is a bounce. I think people will probably, you know, take position in it.
All right, before we let you go, you say there are some defensive ways to play this market. You have 2 interesting picks, very different picks. One of them is Dave & Buster's, I believe. And the other one's IBM. IBM reports after the bell tomorrow. Give us the short elevator pitch for both.
Yeah, so, you know, in the small cap area, that particular name, and not the analyst on it, but I just picked it out of like people covering it. These are companies that are not affected by a strong dollar, not really affected by higher rates, and have a very good domestic base. So the small cap area has been somewhat of an uplift for that sector, like as in if you're not affected by the dollar in particular. IBM has been this very conservative, steadfast name in the tech route. And I think it has proven over and over again in each sell-off, it stands its ground. It obviously had, you know, solid earnings. Has not been so affected by other tech drawdowns that we've seen. So I think it remains a good name.